Hi, I'm Jeni Brown. Welcome to this week's MFB News. I hope everything is absolutely tickety-boo in your world. All fine here. Just working away and really just kind of, I think, riding out this year, to be honest. It's been one to put down to experience, isn't it? So let's hope 2024 is kinder to us than 2023 has been. Anyway, moving on to more positive things. We're going to do our usual roundup on what's been happening with lender pricing, talk a bit about swap rates, also how we think the inflation news, which is due out tomorrow on Wednesday, today is Tuesday, how we think that's going to impact the market and interest rates there. We're going to talk about the housing market, what's going on with house prices, give you some forward-looking views on what's going to happen with those. Also, same for rents. Then we're going to talk about mortgage arrears numbers. So actually, the buy-to-let borrowers are being more adversely impacted by mortgage arrears than homeowners. So we're going to touch on that data and really tell you what's been going on that side of things. And then finally, we're going to wrap up with our usual feature question of the week. Okay, so first up, interest rates. So we have seen swap rates really kind of just stay at the same level that they were last week. So as of today, and as I said, today is Tuesday, I would normally try and record this video on the Wednesday, actually, when the inflation news was due out, but my diary just won't let me do that tomorrow. So I'm really sorry that we can't be giving you up-to-the-minute inflation information. But nonetheless, today on Tuesday, two-year swap rates, 4.780%. 1 month ago, they were at 5.020 and 1 year ago, 4.192. Very sort of similar kind of vein in terms of the pattern of movement of rates on 5 years. So today, 4.274. 1 month ago, 4.468. 1 year ago, 3.854. So actually no real change week on week for you guys, I'm afraid. Now, the inflation news is due out tomorrow. We are expecting inflation to be at under 5% when the data is released. I do think that the swap rates have largely already built this in. We may see a small step down in terms of fixed rate pricing on the capital markets tomorrow, which may then filter through to mortgage rates. But actually, I suspect that the recent step down we've seen in swap rates has been an anticipation of inflation data coming in at below 5%. But let's just wait and see, and we'll obviously keep you updated. Now, as mentioned last week, we'd seen swap rates kind of suddenly move down a bit, and we hadn't seen lender pricing change. Actually, what we've seen in the last week is a lot of lender pricing changing in response to that. Excuse me. Now, it was interesting. I was chatting to a lender who came in to see us, a fairly large high street lender, and I just said, you know, when you want to bring out new rates, how long does it take you to bring them to market? And they were saying that actually on average for a lender, the process of speaking to their treasury department, understanding what the rates could be, getting their product design people to sign them off, getting compliance to sign it off, uploading them onto their systems, all this stuff, it takes broadly a week for a lender to update pricing. So this is why there's a lag between any kind of real change in cost of funds, your swap rates, and then the actual lender deals coming online. So that's why we've had a bit of a rush on changing this week compared to the previous week. So we've seen Virgin reduce their pricing. They've reduced their remortgage and purchase exclusives by up to 0.24%, and rates here are now from 4.81%. Virgin, lovely high street institution type lender, lending to individuals only. No more than 10 buy-to-lets in the background for these guys. You can, or you don't have to have a sort of arbitrary level of income to access a mortgage with them. Things that Virgin do really well, they can do deck access. So if you imagine a flat which is accessed via a balcony that runs along the outside of the building, so your front door is essentially external to the building, rather than traditionally we'd think of a flat, you know, you go up some stairs, there'd be a landing and the various front doors would be internal. So not every lender likes deck access. Virgin are good with these. Another thing they can do is day one remortgages, which is quite unusual for a high street lender. Now with Virgin to do a day one remortgage, they are going to be considering how much you paid for the property and what you have done to warrant any increase in value. So there will be questions asked, but in principle they can do those for you. And that's kind of it from the high street end of the market. But the specialist lenders have been absolutely going for it. So Fleet Mortgages, first of all, have reduced their 7-year fixed rates by 20 basis points. So 7-year fixed with Fleet now from 5.34%. Paragon have brought out a range of new products. So 5-year fixed rates are starting now from 5.15%. With a 5% fee. They have got actually some other rates which are lower but with a higher fee again, but this is the one that's just come out. And also rates from 6.1 with no arrangement fee at all, which is really good. Foundation, they've made some reductions pricing now from 5.69. West One have made reductions of up to 0.24%. So their 2-year fixed rates are now from 4.29, 5-year fixed rates from 4.58%. We've also seen Zephyr Home Loans reduce their rates. So 2-year fixed rates now from 5.35, 5-year fixed rates from 5.95%. Vida, they've joined in the party as well. So their 5-year fixed rates have come down and they're now starting from 4.99. And LendInvest have also knocked up to 60 basis points, so 0.6% of their buy-to-let products. Their rates are now starting from 4.19. Now, as always, just to say that the lenders I've just reeled off, apart from Virgin, specialist lenders, these guys can lend to you as an individual or as a limited company. They can do HMOs, they can do multi-units. They don't mind how many properties you've got in the background. Broadly, they don't need you to have an arbitrary level of income to access a mortgage with them. And then within each of these lenders, they've all got their own kind of very niche bits of lending policy, which will set them apart from their competitors. But what is kind of really interesting to see is there has been a notable kind of wave of downward pricing from those institutions. And I suspect we'll see a very, very similar pattern over the coming weeks. So we'll update you on that next time around. In terms of lending criteria changes, there's been two, one positive, one not so positive, both really sitting around rental calculations, which I think is the area which lenders are probably struggling with the most. So let's talk about BM Solutions first, because they've changed their rental calculations favourably. So essentially you can borrow more per pound of rental income with BM Solutions today than you could do a couple of days ago. So what they have done is they have changed their stress rates for remortgages with capital raising and also purchases and let to buys and further advances as well. So now if you're taking a 2-year fixed rate with them, the rate at which they're going to stress your mortgage at, so it'd be 145% coverage, assuming an interest rate of 6% or the pay rate plus 0.2, whichever is the higher. On 5-year fixed rates, it's 145%, assuming an interest rate of 5% or the pay rate plus 0.5%, whichever is the highest. They've come down there. Interestingly, on their like-for-like remortgage propositions, this is where you are taking your existing mortgage, you aren't borrowing a penny more of money, but you're moving it to a new lender. Some lenders will offer a more generous rental calculation than they would on a remortgage where you're capital raising, for example. So on here, the 5-year fix is still 145% at 5% or pay rate plus 0.5%. But interestingly, they've really come down on their 2-year calculation. So this is now 6% or pay rate plus 0.5%. So it's quite apparent here that what BM Solutions are doing is recognising that their rental calculations are maybe slightly out of kilter with the market. Maybe they're feeling slightly more bullish about the direction of travel with interest rates. So they're able to kind of relax a little bit and make their rental calculations slightly less onerous. So good news from those guys. As always, if someone like BM Solutions, the Mortgage Works, Paragon, the really kind of big hitting lenders in the market, if they make a change like this, invariably other lenders really do start to scratch their head and revisit their lending policy and just make sure that they're kind of doing all they can to support landlords in that area. Now, Shawbrook have also made changes, and this is now in relation to the background portfolio. It's not the property which they're mortgaging, but other properties which you own in the background. So what they have done is they've increased the calculation. So what they're saying now is that background properties, the rental calculation needs to cover 125%, assuming an interest rate of 6.5%. That was 6% previously. So not a massive change, but a change nonetheless. And why they're doing this is essentially they're saying that they recognise that actually because of the increased cost of interest rates and borrowing, actually people's mortgage costs will have increased. So to not stress the portfolio at a higher level than they were pre all the interest rates going up would be slightly remiss. So that's why we're seeing this change. Shawbrook aren't the first lender to have brought this change in, and I'm sure they won't be the last. Okay, now we've had our first kind of very direct prediction on what rents are going to be doing next year. So are your rents going to be going up or are they going to be going down? And so property consultancy JLL says that the lack of new rental stock and a challenging interest rate environment, which is putting off people buying property, will lead to rental growth exceeding wage growth next year, with rental prices across the UK expected to increase by 5% in 2024. So there you go, guys, hot off the press. First kind of line in the sand. JLL are saying that rents should increase by 5% in 2024. And that's following an increase this year of circa 6%. It does depend regionally where you are in the country, but average rents in the UK have increased 6% this year as well. They're citing the undersupply of homes, increased rental demand, lack of people buying property because of the higher interest rates, and also net migration continuing to increase, all as kind of factors that are going to continue to drive up rental demand and therefore underpin rental growth in 2024. Okay, now in terms of house prices, now I know we talk about these often, and generally speaking, we're kind of citing Zoopla, Rightmove, those kinds of property-related companies. So I was quite interested to see that a company called Bloomberg Economics had given out a report in terms of what they think is going to happen with house prices. So I thought it'd be interesting to kind of give a counter view from a non-property orientated company for you. So what they're saying is that the slide in UK house prices has got further to run, despite some indications of stabilisation. Data from mortgage lenders, Halifax and Nationwide Building Society both showed house prices edging up in October amid a lack of places for sale. However, it suggests that property will escape the crash that had appeared possible when mortgage rates started to soar. So you will remember, I'm sure some of our favourite newspapers will have run headlines with house prices predicted to drop by 25-30%. I can remember those headlines myself, incidentally. It looks like that's not going to happen. However, Bloomberg are maintaining their view that prices will drop around 10% from their peak of last year. So essentially, over a 2-year period, house prices will have dropped by 10%. Now, what they have said is that more expensive mortgage costs will remain a significant headwind for house prices, as households ultimately have less buying power. Home values would probably be more under pressure were it not for supply remaining limited, as historically low unemployment prevents forced sales. So essentially what they're saying is that actually if there were more properties for sale, then we'd probably expect house prices to become under more pressure. But actually, because there's so few properties for sale at the moment, that's really kind of helping to underpin the prices which these are going for, because for every property that is for sale, there's still quite a large number of people that actually still want to buy. So that's kind of propping things up. Now, what they said is they expect a steeper decline in prices towards the end of 2023, with relief not expected to come until the Bank of England starts cutting rates. And this is a bit I think you'll find interesting. This will come in the third quarter of 2024. They go on to say that a resilient labour market and a limited supply of properties up for sale may put floor under house prices. So I think the kind of key takeaways are that actually from the start of this year to the end of next, they're expecting that house prices will have come down by circa 10%. They're expecting base rates to start easing down in the third quarter of 2024. Now we're just going to touch on the numbers for mortgage arrears at the moment. And I know it's not the most cheerful of subjects, but I think it is really important to remember that there are people out there who are finding things incredibly difficult, and there will be some of our landlord colleagues amongst those. So the number of buy-to-let mortgages in arrears has risen by 29% to 11,540 in quarter 3 compared to the previous quarter. And this is based on data that's been released by UK Finance. Homeowner mortgages in arrears rose by 7% on the previous quarter to reach 87,930. So the latest rise in the numbers of borrowers struggling to keep up with repayments takes the total number of homeowner mortgages in arrears to 1% of the outstanding stock and 0.57% for buy-to-let loans. So essentially the number of, as a percentage, landlords who are in arrears is less than homeowners, which is good news for the landlord community. Now, what they go on to say, which is quite interesting, is in 2009, following the financial crisis, the number of homeowner and buy-to-let mortgages in arrears was more than double the current figure at 207,200. UK Finance says this reflects the benefits of lender stress tests carried out to ensure borrowers can keep up with their mortgage payments in the event of interest rate rises. So I think really what they're doing is making a nod to the fact that after the credit crisis, a lot of kind of measures were brought in place, particularly rental calculations and affordability calculations, or they were kind of tightened to ensure that actually people had more kind of wiggle room to be able to absorb interest rate increases. And it appears that actually this might be paying some sort of dividend by reflection of the numbers of arrears that we're seeing. Now, what they've gone on to say, which is quite interesting, is that the interest rate pressures are felt more acutely in the buy-to-let market because not all landlords are able to raise rents to cover their increase in their monthly payments. Despite the number of distressed mortgages on the rise, possession figures have decreased by 9% to 630 for homeowners quarter on quarter, while remaining steady in the buy-to-let sector at 450. So we are seeing an uptick in the number of people who are falling behind with their payments, but it seems that by having good communication lines with their lenders, kind of dealing with things square on and making sort of arrangements to pay, people are actually facing or avoiding facing repossession, which is really, really good news. Now, what I would say just now is that if you are struggling with your mortgage payments, absolutely 100%, the best thing you can do is immediately pick up the phone to your lender and have this conversation with them. The lenders have a kind of responsibility to you as a borrower to make sure that repossession is the last resort. That's not something they want to do, and they will try and work with you to try and find a solution to ensure that you can kind of get back on top of things again. So please, please, please don't bury your head in the sand, and pick up the phone and speak to your lender. Okay, now question of the week. This was one that one of my colleagues in the office got asked, and it's such a good question. So the question was, I own one flat in a block of 4 units and I also own the freehold to the building. Why is this a problem for mortgage lenders and what are my chances of actually getting a mortgage? Now this is one of those things which comes up occasionally and actually can cause real problems for people. So the reason lenders become quite nervous if you control the freehold is that if they were to repossess your property, your flat, as you control the freehold, you can actually kind of make their lives very, very difficult in terms of the repossession. So you could block access, you could ramp up the ground rent and service charges, thus making the property unsaleable. So you can kind of control things and make lives very, very difficult for the lenders. And there have been a series of kind of examples of this where lenders have become quite unstuck actually, because owning the freehold meant that their borrower, who was massively in arrears, was able to kind of do things which meant that repossession became impossible for them. So that's why lenders are quite nervous of this. Now, in terms of your ability to actually get a mortgage, I mean, the short answer is yes, there are lenders who can get very comfortable with this, and they can do this in a couple of ways. So some lenders just say, actually, we're not worried. You own the freehold, so what? We'll take our chances. That's definitely one answer. Conversely, there are some lenders who say, is if you own or control of the freehold, we're not touching you. But the third possibility is there are some lenders who say, okay, fine. Well, look, what we will do then is we'll lend on the leasehold flat, but we'll also take a sort of non-monetary value charge, a comfort charge is the technical term, on the freehold. So that actually, if we do want to repossess your flat, we can come in and manage the freehold of the building, which means that kind of would obviate any kind of risk of you messing around and making our lives difficult. So we can kind of protect ourselves from that way instead. So I hope that answers the question. And explains it clearly for you. But as always, if you did want to have more information about it, you can always just give us a call. And likewise, just please keep the questions coming. It's actually quite fun to be answering questions like this. So yeah, if you do think of anything you'd like to know, just pop it in the comments below or just email in or phone up, whatever you want to do. And I'll be very happy to cover it off in the next couple of weeks. And that's me signing off for yet another week. So I look forward to being back with you next week. We can talk about the inflation data, what's happened with the interest rates, and I'm sure there'll be loads of other great stuff to be covering off. I just want to say, actually, in the office today, we took our first delivery of Christmas wine. As a business, we're very fortunate. Lots of kind of lenders and other suppliers will send us in boxes of wine and chocolates and sweets and stuff. And the first one arrived today, so I feel like we are now actually moving into Christmas mode. So expect the Christmas tree to be glistening away in the background in the next couple of weeks. Thank you so much for joining us as always. We do genuinely appreciate the time. Thank you also to those of you who leave comments below. It's really, really nice to read them. Just so glad that you find these videos useful and, somewhat educational. But as always, if you have any questions, we'd love to hear from you. 0345 345 6788. And as always, there's loads of information on our website. It's just started to pour down with rain again. So let's hope it dries up for the weekend and I'll see you next week.